This conference will now be recorded.
Okay, good morning, everybody, and welcome to this session on company cars and the electric revolution. I know these are very difficult times at the moment. We see what's going on in Ukraine, and we can only sympathise with our colleagues over there and wish them all the best. So, I just want to put that into a little bit of context before we actually start. As normal, this conference is going to be recorded and will appear on our YouTube channel later on today. You have the facility of the chat box, which is a speech bubble in the top right hand corner of your screen. If you've got any questions, chuck them in there and we'll happily answer them if we can. And the session, as you know, is being recorded and is going up on our YouTube channel later on today. So please feel free to catch up on anything you may have missed on there. And first of all, we have to talk about we have to mention our disclaimer. The following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of its affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. Okay. We also have a brief government update to give you as well. The government is covering the cost of statutory sick pay for COVID-related absences for small and medium-sized employers across the UK. However, the scheme is ending in a couple of weeks' time, and after that, normal rules will then revert. So the funding for the statutory sick pay is stopping on the 17th of March. So just bear that in mind. If you're struggling to pay your self-assessment income tax, then you can still make an arrangement to pay online. You've got till the end of the month if your liability is less than 30,000. There'll be no penalties for late payments if you make that arrangement, as I say, by the 1st of April. And it's an online system. You don't have to talk to anybody, and you can spread your liability over 12 months. We have a national insurance rise of 1.25% from the 6th of April 2022, and it is still on at the moment. And it also applies to dividends, but you'll see later, not company cars. And the child benefit, we mentioned this on previous webinars, the HMRC are on the attack for this. They think it's easy winnings for them, it's low-hanging fruit for them. If you've been claiming child benefits and you shouldn't have been, they are going to come after you, and they are looking to go back 6 years. So it applies where either party in the house is earning more than £50,000. You have to repay some of your child benefit. Once the earnings are over 60,000, then you have to repay it all. So if you have two people in your household earning £49,000, then you get full child benefit. If one of you is earning over 60,000, you don't get any. And you have to bear in mind that earnings does include benefits in kind, and it does include therefore company cars. So that's the relevance for today. On the job retention scheme payments, HMRC are also looking to see whether you have incorrectly claimed job retention scheme payments. If you have, now's the time to repay it. The amount of fraud in this sector is just mind-boggling at the moment, and they're looking to have proposals to make company directors personally liable as well. And whilst we're on it, the Let Property campaign is still open. So if you have property, I'm sure none of you here it applies to, but if you know of anybody that has some property which they may have forgotten to declare their income on, then there is an opportunity to come clean with a very much reduced penalty regime. So please get in touch if you need any further details on any of the above. And as a reminder, the national minimum wage and the national living wage is increasing from the 1st of April. So at the end of this month, the rates go up, and the main one everyone tends to look at is the 23 and overs. It was £8.91. It's going to £9.50. So there's a fair increase in there as well. So that's our government update. Keep up to date with other stuff as well. You can follow us on Harts Limited on LinkedIn. You can follow us on YouTube. We've got some exciting stuff coming up. We're going to be doing some podcasts fairly soon. If you'd like to be involved in any of the podcasts, give me a ring or drop me a line, and maybe we can include you in our podcast session. And then follow us on Twitter at Harts Accountants. Our next webinars on the 17th of March in a fortnight's time. We've got some networking skills and tips from Sarah White, who is the founder of Networking, which is a franchise networking group around the country. 31st of March, we are still finalising the details of that, so we'll come back to you. 28th of April, staff retention, how to look after and keep your staff. 12th of May is on property letting, so should you have run it through a limited company or your own name. And on the 26th of May, research and development, what can I claim for? Funnily enough, the government announced today, Rishi Sunak has announced today, that they're having a look at some proposals to change the way it's been operated because they think it's been too generous. Why it's been too generous, I'm not too sure, but they're looking at proposals. So there are some changes on the way for that. And you can go to our website and book on via the events page. Okay, that's company cars. We're moving on to now the electric revolution. Let's have a look at the current position as to actually how it is at the moment. So we have, as an employee, in relation to petrol and diesel vehicles, as an employee, you're taxed on the list price of the car. And it's not what you paid for it, but the original list price. So for a second-hand car, it's still the original list price when it was new. And you need to include any extras in this. Your tax is based on the CO2 emissions of the vehicle, and the CO2 emissions then equate to a percentage as given by HMRC. And it's that percentage which is applied to the list price to get the benefit in kind. So this is the table which we actually use. Apologies for the red at the top, which has spotted a typo at the top, so I've just amended that. But as you can see, I've included 4 years worth here, and I've included 2021, although it's gone, just to give you an idea of the way things are actually going. So if we ignore the electric bit to start off with, because that applies to hybrid vehicles only. So if we're looking here at the rates, you can see that petrol rates for a very low emission car at 13% of the list price last year, currently 14%, going to 15%, and 15% for 23-24. The 24-25 rates are supposed to be kept at 22-23 rates for now. But we know the government is short of cash, so is this going to change? We don't know. It could change at some point in the future. So what we do is we take this CO2 emissions figure on the left-hand column, and then we see where does your car fall in that, and it'll be the official CO2 figure, not one that may have been made up by some car companies. It's the official one. And we apply the relevant percentage as to whether it's petrol or diesel. Now, if you've got a diesel vehicle, there is an additional 4% that's added on to the percentage. So as you can see here, in the 65 to 69 range, petrol would be 16%, but diesel is actually 20%, or 18, 17%, and 21%. Unless, of course, your car is RDE2 compliant. Now, RDE2 compliance is all to do with the CO2 emissions for new cars. I think it applies from April 21 onwards. You'd have to check whether your car fell into it. If it did, then you can use the lower rate. You don't have to use the higher rate. So what does that actually mean? Well, let's look at an example. Let's take a Land Rover Discovery, quite a popular car out there. We're looking at a 2-litre diesel. It's got an automatic, it's got a 220 CO2 emissions with a list price, the last time I looked, at £56,045. So the calculation for that, if we go back to the previous slide, we see the 220, we can see that that's actually at the top rate. It's at 37%. So we get 46,045 at 37. That gives you a benefit of £20,737 as a benefit. You are then taxed on that figure. So for a basic rate taxpayer, that's going to cost you 20% of that figure, meaning it's going to cost you £4,147 in tax. For a higher rate taxpayer, it's going to cost you double that at 40%, so £8,295. Now, the company can also pay for your private fuel as well. So if the company pays for your private fuel, it doesn't happen that often. There is a set charge to the private fuel amount which is currently 24,600, and you apply the same percentage at 37% at your tax rate. So for a basic rate taxpayer, it will cost you another £1,820 per annum if the company pays for your private fuel. One thing you want to work out then is, well, how much fuel am I spending, or how much private fuel am I spending each year? If it's less than £1,820 in private fuel, there is no point in me having that private fuel benefit given to me by the company. You might think it's a great benefit, but it can actually be costing you money. So you need to have a look at this and have a look at the calculation. In addition, and we've got a lot of owner-managers on the company, shareholder owners and directors of their own company on the call. The company will also pay Class 1A national insurance on the car, and that's calculated at the rate of 13.8% of the benefit. So I'll take this example here. We've got 56,045 at 37%. That's the benefit figure, and we're multiplying that by 13.8%. So the company will pay out £2,862 in the current year as a Class 1A cost. Yes, the company will get tax relief on that payment at the rate of 19%, but it's still going to cost you £2,862. Bear in mind, we have a national insurance rise coming in, and the national insurance rise is at 1.25%. So that 13.8 is actually going to 15.05% from the 1st of April. However, it doesn't apply to the benefit in kind, so you're still only going to get taxed at your 20 and 40%. So from the employer's perspective as well, let's have a look at what they can actually claim, because there are capital allowances available on the purchase of the vehicle. Now, purchase includes buying on HP or buying it as a loan. It doesn't include leasing and contract hire, which we'll come on to. Personal contract purchase is a bit of an odd one because by the very name it's called personal contract purchase, but these are also now available for a company. And these are a little bit more complicated and very much depends on the terms of the agreement. The way we see it is that if the final balloon payment is clearly well above the expected market value of the vehicle at the time of that payment, then it will be eligible for capital allowances. So if we've got the writing down allowances, the capital allowances available for a car, if it's got emissions lower than 50 grams, which is very low emissions, it's not zero, then it's at 18%. In most cases, it's going to be at 6% because your emissions are going to be above 50 CO2s. So unless these emissions are zero, capital allowances are the same for new and second-hand vehicles. So the claim, as you can see, is only small. So if we go back to our previous example again, we've got a £56,000 vehicle. The company will be able to claim 6% of that, and it gets 19% tax reduction. That actually means it's £639 that's actually you're saving. Not a great deal of money in relation to a high emissions vehicle. Let's have a look at some hybrid vehicles now, because these are slightly different again. So the car tax depends on the miles you can do on an electric car, provided the emissions are less than 50 grams. So it's an electric charge. So let's go back to our previous table, and we're looking at the top part of this table up here. As you can see, it's got to have CO2 emissions for a hybrid vehicle in the range of 1 to 50. Now, if then it will look at how far it can actually go on the electric charge, and this will be the official figures for that vehicle. So let's go back to our example and say, a car with an electric range of 50 miles will have a benefit in kind rate of 7%. So again, let's go back to here. It's got a range of 50 miles. It's falling in this band, and in the current year, we've got a 7% charge. So you're going to have a 7% charge on here. So we take our hybrid car with a cost of 56,000 using the same example for ease. It's 7%. The benefit in kind is £3,923. So for a basic rate taxpayer, it's £785. And for a higher rate taxpayer, it's £1,569. So as you can see, a lot less than having a diesel vehicle, having a hybrid vehicle. The fuel benefit also applies where the company provides private fuel. It doesn't apply to the electric bit that's just provided. So as you can see, it's much more beneficial than a petrol or a diesel, but still can be expensive compared to personal ownership. Capital allowances are similar to that of petrol and diesel, so not a great amount to claim, and you've still got the Class 1A national insurance to pay as well. So that's really where we stand at the moment with petrol, diesel and hybrid vehicles. Let's have a look at electric vehicles, because this is where the real benefit arises for everybody. If we have a look at it now, the benefit in kind on an electric vehicle is currently at the rate of just 1% of the list price. This is due to rise to 2% in April this year, but is set to remain at 2% for the time being. So let's take our example again. Let's look at that vehicle, which is at £56,045. The benefit in kind is just £560, being 1% of the list price. So the tax payable is just £112 for a basic rate taxpayer and £224 for a higher rate taxpayer. As you can see, a huge saving on having a petrol or a diesel vehicle. And this is way cheaper and the best option for everybody. However, and also there are other benefits to claim as well. So if the company buys the car, and it has to be new and unused, doesn't apply to used vehicles. So if the company buys a new and unused electric vehicle, then it's entitled to claim the full amount against its profit for the year. And the same definition of purchase as applies previously, so we're talking HP and loan. In our example, this would mean a tax saving of £56,045 at 19%. That's a £10,649 as a one-off reduction in your corporation tax for the company. If you remember our previous example, it was just £600 odd. A massive win for both the employee and the company. However, just bear in mind that when the vehicle is sold, it will pay corporation tax on the full proceeds. However, it's always going to be a lower figure because of the depreciation that applies to it. And also, if you're going to be replacing one with another, you are going to get the full allowance when you buy the new vehicle. The employer still pays Class 1A national insurance on the benefit at the rate of 13.8%, which is rising to 15.05% from April. So currently £560 has been your benefit at 13.8% is just £77. So massive tax incentives for us to be changing over from petrol diesel to electric, and even from hybrid to electric. You may ask, we may wonder why the government is giving such generous things to do. Well, it's all about emissions and clean air and so on, and we've seen all the hassle over the clean air zone in Manchester and how people don't want to pay and how it's affecting everybody. There's got to be some changes at some point, because the more and more people who change over to electric, the less money is coming into the revenue and less money is coming into the government in fuel duties, tax and so on. So it's a question of getting in now while you can. We don't know what the rates are going to be in the future. I don't have a crystal ball, unfortunately, but we can only assume that at some point there are going to be changes in the way the tax system is going to be working in relation to electric vehicles. Let's have a look at some leasing. When a company leases or contract hires a vehicle and the ownership never passes to the company, the tax position is as follows. The leasing costs are deducted from the company's profits. However, from April 21, there is a lease rental restriction. So for contracts entered into from April 21, tax relief on expenditure for lease cars will be limited according to the CO2 emissions. So if you're leasing a car and its CO2 emissions are 50 grams or below, you get 100% of the cost of the leasing cost going through. And there's no disallowance. If it's above 50 grams, then you have 85% is allowed for tax, and there's a disallowance of 15% in relation to the leasing cost. If you lease a car, you can usually claim 50% of the VAT back on the leasing payments. You may be able to reclaim all of the VAT if the car is used for only business purposes and not available for private use, but this is very rare. And the same applies to contract hire or anything that is similar to a lease. You generally can't claim the VAT back on the purchase of a vehicle. So let's go back to that company car summary. Let's have a look at what we had in the example, where the cost of the employee was based on our example. The basic rate taxpayers, the costs here are tax payments that are actually being made payable. And you can see the benefits compared to a diesel or a hybrid and the electric cost compared to that. So that's why there's this big shift of moving everybody across to electric. We've seen how all the car companies are starting to bring out more and more models now as well, and it's mainly because they've been told we can't sell any new petrol or diesel vehicles from 2030. We're already 2022, it's only 8 years away. A lot of people buy cars and hang on to them. If you were buying a car now and hanging on to it for a number of years, what will that be worth when you come and try to sell it in a few years' time? Who's going to be buying these sorts of vehicles? Not many people would have thought, so potentially your car could be very much worthless in a few years' time if you're buying new petrol and diesel. There is a window, maybe if you're leasing one, that's fine because you get rid of it after the 3 years or 4 years or however long that's going to be. But there's going to come a point where you're only going to be really looking at buying an electric vehicle as it stands at the moment in relation to tax and so on. What I want to do is come on to a number of other points which are also relevant in what we do. We're often asked, oh, well, my car's just a pool car, and therefore there's no benefit in kind to it. And invariably, you're wrong, because HMRC will look at this. And a car only qualifies as a pool car if all of the following conditions are satisfied. It's available to and actually used by more than one employee. It's made available in the case of those employees by reason of their employment. It's not ordinarily used by one of them to the exclusion of others. And any private use by an employee is merely incidental to their business use of it. And it's not normally kept overnight on or near the residence of any of the employees unless it's kept on premises occupied by the provider of the car. You've got to meet all of those conditions for it to be a pool car. The amount of pool cars we see are very small. In most cases, if you've got a pool car, basically you've got to leave it in the office car park overnight or your premises car park overnight. You've got to make sure that everyone is available to drive it and anyone can pick up the keys at any one point and drive it. The definition of a benefit in kind for a normal car is it just has to be made available to the employee. So the fact that you might not use it for anything other than business is irrelevant. So if we're not looking at pool cars now, we're talking about just normal company cars. If that car is made available to you for private usage, then it's a benefit in kind. The fact that you might not use it for private usage is not relevant. It has to be made available to you. We're often saying, well, my wife's got a car, we use that one all the time. That's not relevant because they may turn around to you and say, well, what happens if your wife's gone out or your car's not there and you've got an emergency and you jump into the car and you're using it for personal purposes. That car has been made available to you for private use and therefore it is a company car. Let's touch on company vans. You not need to report your van if it's all of the following. It's available for use and used by more than one employee. Available to each employee because they need to do it for the job. It's not ordinarily used by just one employee to the exclusion of others. It's not normally kept or near employees' homes, and it's used only for business journeys. However, there is limited private use allowable, but only if it's incidental to a business journey. For example, driving home to allow an early start in the morning. We also got to remember as well that it can be used for home to workplace for common commuting because that's treated as business for a van. It's not the same for a car. And it is a common misconception. People often think that you use your car from home to work. Home to work in a car is not business use, that is private use. What we do suggest, and we suggest this to a number of clients, is we put this in an employee's employment contract and advise them they are not insured if the van is used for private use. And that way also you can get around any benefits in kind rules. For vans used for private journeys, you need to report them as a standard value. There's a standard rate which applies to vans, that's £3,500 to HMRC. So it can be reduced if it's not been used on those conditions. Your employee pays you privately or other employees use the van. You divide that 3,500 by the number of employees. And there's van fuel, so it's private fuel, it's only £669. And again, the same rules apply in relation to not having to charge that benefit. So as you can see, it can be a lot more beneficial to have a company van. And there are a number of vehicles which do classify as company vans. And the obvious one is the double cab pickup, which has got an open back to it. That effectively is treated as a van. So if you want to drive around in one of those big gas guzzlers, then you can do so, and there will be a much reduced benefit in kind charge for you. What we can also provide you with, and it's a use of van agreement. We've done this to a number of clients before. You give this to your employee and you can actually say that you're not allowed to use it. It's only for travel on company business. The employee is only permitted to use the van for ordinary commuting and so on. That is available to us. If you want that, just shout. I want to just come on to a couple of other matters as well. Which we've been talking about this just before we came onto the call with one or two of you, where an employer pays for the installation of a home charging point associated with the provision of an electric car, that is benefit in kind free. So, and this is in the HMRC's guidance, so there is no taxable benefit as a result, and that only relates to a company car. However, it also makes it clear that if it's your employee's own car, it doesn't qualify for that. So if you're buying your own car and your company puts in the charge point and pays for it, that will be a taxable benefit in kind. As you can see, the tax rise of 1.25% in April doesn't apply to company cars. The employee won't pay more, but the employee will see the Class 1A national insurance charge rise to 15.05%. And we've mentioned briefly the congestion charge is coming. They've said it's only going to apply to vans and buses and taxis and lorries, etc. But it applies to all cars in London. It applies to other cars in Birmingham. So why shouldn't it start to apply to vehicles here in Manchester, Greater Manchester area? Who knows what's going to happen, but it's likely that electric vehicles will be exempt in the short term at least. So there's a potential of a saving. But if you're travelling around the country in your electric vehicle and you're going to other city centres, there will be a saving there as well. You won't have to pay congestion charges. We're also asked occasionally on company motorbikes as well. What if the company buys a motorbike? We might have some bikers out there and say so there is similar rules apply. However, the cost of the motorbike, say, is £8,000, and we look at this as inclusive of VAT. The employee is taxed at the standard rate of 20% on the cost. So in this example, the benefit in kind is £1,600. So for a basic rate taxpayer, that would be £320, and a higher rate taxpayer is £640. If the running costs are paid for by the company, then they are taxed on the VAT inclusive amounts of this as well. So if the company pays for the running costs, there's not a standard rate. What you have to do is add up all the running costs for that motorbike, and you multiply that by 20%, which is the benefit, and that is the amount which goes on the employee's tax return. And the company will also be able to claim capital allowances on the bike, and the company will pay national insurance on it, and so on. Now, one other thing to mention is that we have the super deduction at the moment. So invariably, you should be able to claim 130% in relation to motorbikes and vans. It doesn't apply to cars. So if you're wanting to buy some more vans, there is 130% capital allowance available at the moment. Alternatively, the employee might own the bike personally. They can claim 24 pence a mile for their business trips. Let's have a look at mileage rates. They may well be no longer having a company car. These actually haven't changed since 2012. So for 10 years, rates have been going up, costs have been going up, approved mileage rates have stuck exactly where they are. So for cars and vans, it's 45 mile for the first 10,000 business miles and 25p a mile thereafter. The company can pay that on a mileage claim to the employee, and it's tax-free in the employee's hands, and it's tax deductible in the company's. For motorbikes, it's 24p a mile, and for bicycles, it's 20p a mile. And you should keep a mileage log to support this if HMRC ever ask. You can reclaim the VAT on the petrol element of this, but you need to keep petrol receipts, and the amounts involved are very small, so many potentially don't bother with this. So that goes through as a quick whistle-stop tour through electric vehicles, company vans, company cars, motorbikes, bicycles, and so on. So let's have a look. We've got one or two questions. No, we've got no questions here at the moment. So if anybody else has got anything they want to ask, please feel free to unmute yourself or put it in the chat box. Happily answer questions and see if there's anything we can do.
Hi, Steve. Thank you.
Hi.
John Parton here. Thanks for the presentation. Just a quick
Yep.
one. So I wouldn't be surprised given the number of folks on this call. I do very few business miles. Home office space, especially at the moment, you know, I can count them in a few hundreds a year.
Yeah.
So if I'm very attracted by the possibility of an electric company car, which would save me, would be obviously for what you've shared a no-brainer.
Yeah.
But I won't be able to claim to the revenue that I've used it for business, not significantly. How does that impact?
It doesn't matter is the answer to that. The fact is the company has provided you with a car, and the company will be able to receive the tax benefits for doing so. The fact that you're not using it much at all, it doesn't matter. The car is being provided to you by the company.
Thank you. I thought that might be an embarrassing question if ever asked, but no, thank you.
Not at all. If you're thinking about it, then there's bound to be other people who are thinking about it, so I wouldn't worry about it.
Good.
Right, just having a look here. When is the 130% capital allowance finishing? I believe it's next year, but it's worthwhile. I will double check and come back to you, but I think it is actually next year. I think it was a 2-year deal. Whether they extend that or not is another matter, but let's wait and see with that. I've got a question here. Mr. Stark, due to PC issues, wondered if you're better off taking a car allowance or joining the company car scheme. Again, it all depends is the answer to that one. I can't give you a definitive answer, but what we do have is if you want to supply us with some information, we have a calculator which we can use to determine which is going to be the best for you as to whether to take the car allowance or whether you have a company car. Our next question is, are there any limits claiming tax relief on buying more than one electric car in the next year? If you're talking about company cars and you're giving it to a number of employees, no, there isn't. We have a client I went to a couple of weeks ago. They have put in 5 chargers at their factory, and there are about 5 or 6 Teslas all lined up using the company electric, which is free. There is no benefit in kind for that, so the company can buy it for a number of their employees. If I have a company car, can my wife drive it as well? Yep, no problem with that at all. As long as she is on the insurance, you just have to make sure that the insurance covers her for that as well. And the question about hardly using miles, can it be used for private miles? Yes, it can. It's a company car. The benefit in kind is designed to cover all business and private miles. Anybody else? Anybody else got any questions at all? Feel free, you can unmute yourself, stick your screen on, happily chat to you about it. Or if you want to just hang fire, I'll be on the call for a few minutes after we stop. I think that's it for the questions at the moment. Oh, can you clarify if you sell after getting tax relief? Okay, so if you bought the car, we have our example of £56,000. If you bought the car for that and you've had £56,000 worth of relief, if you sell it in 3 years' time for say £20,000, the company will be taxed on the £20,000 at the company tax rate. Bear in mind it's 19% now, it's going up to 25% from April 23. So potentially you'll pay a little bit more tax on that. But at the same time, if you're replacing it and the rules stay the same, you're replacing it with a new electric vehicle, you'll still get 100% of relief on the new electric vehicle. So that's basically how the proceeds would work. Okay, I think that's the end of the questions that we've got so far. I'm going to stop recording in a moment, but thank you all very much indeed for joining us this morning. I hope you found that useful. It will go up on our YouTube channel later on today. So if you've missed anything or you want to go over anything, please feel free to go to our YouTube channel or just subscribe to our YouTube channel. That's the easiest way, and then you'll just get notified every time a new video or webinar appears on there. Can you have the slides? Yeah, if you want to drop me an email, I'll happily send the slides over to you. That's not a problem. But again, thank you very much indeed, and have a great day.